So we are starting the live streaming now. Dinesh, you may start.
Okay, good afternoon, ladies and gentlemen. On behalf of CFA Society Sri Lanka and Ernst & Young, I would like to welcome you to today's webinar exploring the key challenges for financial assets of the financial sector in the current context. Joining us today is Mr. Rajit Pereira, partner Ernst & Young, who will be the keynote presenter today. Followed by the keynote presentation, we will have a panel discussion and we will be joined by industry experts from the financial sector. Joining us today are Rachini Rajapaksa, past president, CFA Society Sri Lanka, and an independent director of Nations Trust Bank, as well as Mr. Dilshan Veerasekara, director, chief executive officer of First Capital Holdings, as well as the incoming chairman of the Colombo Stock Exchange. Before we start the webinar, I would just like to remind our participants of few housekeeping rules. We would like to request you to keep your videos off and the mics muted, and kindly request you to forward any questions you may have through the chat function so that we could take it up during the panel discussion. Without further ado, may I invite Rajit to make his presentation. Over to you, Rajit.
Thank you, Dinesh. Kindly allow me to share the slides. I'm not allowed to share the slides because of the existing backdrop which is being shared.
Srinath, is that okay?
Right, until that comes on board, until Srinath allows me to share the deck. Yes, it's done right away. Thank you very much, Srinath. So basically, the objective of the today's session is to discuss some of the key challenges in the financial services sector, specifically relating to financial assets. Of course, with the existing economic challenges in the macro environment, there have been multiple challenges faced by financial institutions, especially with the economic crisis which is coming up in 2022, where financial institutions are challenged from multiple fronts, specifically in terms of determination of expected credit losses, and then managing their financial investments, managing the credit risk, and all of that leads to managing the ultimate capital of the financial institutions as well. So together with that, we're going to combine the management of financial investments from the perspective of business model analysis and evaluate what are some of the key challenges. So one thing that I would like to reiterate is that within the next 45 minutes, I will somehow cover the key areas. Of course, 45 minutes will not be adequate to go into depth in terms of discussion, but I will ensure there are key delivery points at each of these areas where, by and large, the financial services sector is required to focus. So let's look at some of the external environments, events that are unfolding, which of course needs no introduction. All of us are very familiar with some of these numbers that are happening, but in order to put things into context, I'll just bring some of these indicators so that I will be able to link the respective impact of those indicators into determination of expected credit losses for the financial services sector. So if you look at currently, Sri Lanka GDP in 2022 is challenged to a certain extent. By about April, various agencies published that the GDP will be little less than 3%. But however, currently they're contemplating the 2022 GDP growth rates would be somewhere around 1%, looking at the worst case scenarios that could come up. Also, headline inflation by about April, official rates have reached to about 34 to 39%. And also, if you look at some of the forecast available in terms of inflation, looks a bit optimistic, but based on the published sources, IMF forecast there would be towards the end of this particular year, 2022, inflation to settle down somewhere around 17.6, and thereon to gradually get into the normal inflationary growth patterns by about 2026, which is around 6 to 7%, which is slightly an optimistic assumption. However, these are some of the publicly available data. And also at the same time, the interest rates of the country, early April 2022, fiscal policy decision was taken to increase interest rates by 700 basis points, and then subsequently another 700 basis points. Interest rate almost doubled within a short period of time. Much of the economists in the country debated this fiscal decision in terms of how it's going to impact the economy, how it's going to impact the financial services sector. But I think the main rationale of pushing the interest rates up is predominantly to arrest the current economic crisis, specifically in terms of controlling the inflation and controlling the foreign exchange depreciation that is currently taking place during the early parts of the year. So if you really connect some of these activities that took place into the financial services sector up to 2021, the banks in Sri Lanka, this is not the non-banking sector, but the banks in Sri Lanka reported a gross NPL ratio of 4.47, which is a gradual decline. You can see the NPA has declined from 2020 to 2021, but we have highlighted that to bring to your attention. This number, which is reported as 4.47, does not reflect the right portfolio quality of the financial services sector. Some of the reasons are, if you really look at between 2020 to 2021 financial year, majority of the loan book of most of the financial institutions were under moratorium. So if you look at till end of 2021, most of the financial institutions have offered relief schemes under the moratorium packages introduced by the regulator. Because of that fact, good 40 to 50% of some parts of the portfolios were under moratorium, did not necessarily reflect the right portfolio quality. So some of these macroeconomic movements that we saw towards a latter part of 2020 up to 2022, we did not see the real effect of some of those indicators converting in terms of the portfolio quality in the local banking sector. So what we're going to experience in 2022, which is the coming year, where most of the moratoriums are ended by the regulator, chances are some of these NPL numbers will dramatically increase, especially in 2022, where the banks are required to be prepared in order to absorb some of these stresses that are likely to come in order to be tenable, managing their capital and to float during difficult periods of time. As we move along, I will also talk about some of these impacts that are coming in some forecasts, specifically from NPL standpoint. What numbers are we looking at? I'm going to take it into discussion as we move along in the next couple of slides. So if you look at summarizing this particular impact, how these macroeconomic variables is going to affect your loan book in terms of ECL and in terms of your capital structure from the financial services sector, some of these adverse movements in interest rates, inflation, exchange rates is going to directly impact the staging of the financial institutions. So the customers who are rated into stage 1, 2, and 3 and SLFRS 9, there will be a deterioration of staging. In other words, there will be significant increases in credit risk, or if you really put it into the layman's or the regulatory format, your NPLs will increase. So expectation that in 2022 is that by most of the economists and the banking sector specialists is that NPL will cross 10% towards latter part of 2022. And this is for the banking sector, not the non-banking sector. Of course, the non-banking sector NPAs would also exponentially increase accordingly. And some of these macroeconomic indicators, the quantitative variables, would lead to adverse macroeconomic factor adjustment, specifically in year 2022. Because we look at some of these models that are used to build the ECLs are relied on historical data, which is coming from the last 5 years, at a minimum last 5 years data points. So the last 5-year data points does not capture the existing economic algorithm. What we see today, exponential rises in interest rates, headline inflation reaching to 39%, foreign exchange rate at 380 rupees per dollar. None of these economic indicators, reflections are reflected through the historical data set. So your economic factor adjustments, specifically starting from Q1 as well as Q2, which is the 30th of June for financial institutions, will increase the economic factor significantly. Also on the other side, so we were talking about the impact from a loans and advances standpoint, but also from your investment standpoint, there is an additional stress the financial institutions will have to bear because countries' rating have been downgraded by many rating agencies to a restricted default category because of preempting default, with the policy decision that Sri Lanka will not service any of their external debts. So downgrading the credit rating of the country will have a direct impact on the sovereign treasury instruments, which are specifically in foreign currencies, including international sovereign bonds, which we call ISBs, and Sri Lanka development bonds, which are called as SLDBs. So banking sector, which runs a sizable portfolios in terms of ISBs and SLDBs, are likely to have a significant impact, specifically with regard to the credit downgrade that happened in April 2022. All of that, your macroeconomic adversity combined with your downgrades in terms of the sovereign rating, all of that boils down to a serious issue of capital, because end of the day, the financial services sector, from a provisioning standpoint, what is going to happen is whenever the portfolio quality deteriorates, it is going to directly impact your risk-weighted assets in terms of the capital calculation, the Tier 1 capital calculation. It's going to impact your risk-weighted assets. Also, on the other side, when the deterioration takes place in the quality, the provisions will increase. When the provision increases, your Tier 1 reserves will reduce, and that will result in, for most of the financial institutions, their capital adequacy to be challenged. So therefore, it's important for these types of financial institutions, especially banks and finance companies, to start managing their capital more efficiently, effectively, run different scenarios to understand what type of an impact they're looking at, in order to ensure that you are better prepared for some of these difficult times that are likely to come about. Also, the good news is it's not only the adversity that we're looking at, but also when we calculate your economic factor adjustments or the expected credit losses, we are permitted to factor in any potential economic growth trajectories, which I will speak about a little later when you move on to the next set of slides. Right, so we'll move on to the discussion. I think this is just a snapshot which I just shared with you. So basically, from determination of expected credit loss standpoint, from the SLFRS 9 purposes, we're looking at majorly two types of impact. One coming from loans and advances, the other area coming from the investments. So loans and advances, directly, there will be two key areas that we have to focus, especially 30th of June, staging of the loans and advances. The second one is macroeconomic adjustment, because if you really look at it, the staging determination of stage 1, 2, and 3 is going to be critical, because as we speak, certain industries in the country are going through a difficult time, which we call elevated risk industries. Risk elevation has taken place. Specifically, if you look at travel, tourism have been prolonged, they were under stress for a prolonged period of time, construction, and there are many more other sectors which are currently going through a difficult period of time. So those identification of elevated risk industries is going to be very important in terms of determination of staging for the loans and advances impairment assessment. And also on the other side, the macroeconomic overlay, which I will obviously talk about in a little bit more in detail, because there will be lots of management judgments that will come in, management overlays that will come in for you to determine the expected credit losses. If you look at the investment side, similar to the loans, again, there will be two major impacts, which is coming from the staging as well as macroeconomic overlay, specifically with regards to international sovereign bonds, Sri Lanka development bonds. Staging is going to be impacted because, like I said earlier, we are currently in a restricted default category. Definitely the significant increases of credit risk have taken place. Therefore, determination of ECL for ISBs, SLDBs will have to happen at a higher stage, where lifetime loss determination being factored in. Obviously, we should not miss the elephant in the room. We are only talking about the ISBs and SLDBs. Obviously, there will be questions asked about what about the treasury bills and bonds issued in terms of the domestic currency. So as of now, as of today, there is no requirement of a provision for treasury bills and bonds issued in the domestic currency. So we believe they will continue to be under stage 1 in line with the SLFRS 9, because there's no contemplation of a haircut for those type of instruments, and the control over the currency will be with the treasury. So therefore, we don't believe currently it's required to be impaired. But however, depending on how the IMF negotiations, debt restructuring process moves on, if there is the slightest of doubt that there need to be a haircut on rupee instruments, especially treasury bills, treasury bonds, at that point, the financial services sector needs to start looking in to bring in an expected credit loss provision. Because if you really look at IMF talks about debt sustainability. So debt sustainability is where you try to bring down the debt to a sustainable level, and that debt specifically include of the local debt, which is issued from Sri Lanka rupees, as well as foreign currency debt, which is comprising of ISBs, SLDBs, etc. So then if there is a slightest of doubt for rupee instruments that there needs to be a haircut, that's the point in which that your ECL requirements will kick in line with SFRS 9. As of now, we don't need to take that position because we are confident based on the available information. There's no need of a ECL provision for those type of instruments. Right, so this is just to demonstrate to you where your worst case scenarios are going to be. We ran simulative models using different types of regression models to forecast non-performing ratio of the financial services sector. So what you're seeing is two different independent computations performed. One is by picking the MEVs on an expert judgment basis. The second method was we fitted a model to shortlist the macroeconomic variables to best reflect your NPAs, and both results gave numbers closer to about a gross NPA ratio crossing 10% by the fourth quarter of the financial services sector. One thing important that needs to be stressed is that the data set which is used for this forecast is not stressed by any means. So this is business as usual data. So what you're seeing on the slide is the best case scenario. If you do certain stress testing on some of these numbers, and if you exercise a little bit more stressed on some of these variables such as GDP, inflation, interest rate, exchange rate, unemployment, obviously these forecasts will increase by about the fourth quarter up to a maximum of 15-16% as well. So a comfortable range of forecast would be 9% to 15% is a likely outcome in terms of non-performing advances in the financial services sector. So the question for the banks is what this increase in NPL will result in. Obviously, like I explained to you earlier, like I correlated earlier, immediate rise in NPL will lead to a deterioration in staging, will lead to recognition of high provision, which is significantly threatening the capital position of the financial institution. So from the economic factor adjustment, we have to be mindful about few areas, specifically when we do the 30th of June computations. The banks are using qualitative as well as quantitative data sets in order to determine the expected credit losses. The quantitative variables includes factors commonly such as GDP growth rate, inflation, interest rate, exchange rate, unemployment rate. Qualitative factors includes your industry business cycle, regulatory impact, and government policies. One thing important that we need to identify this time, the financial services sector will have to focus on the qualitative factors as well, apart from the quantitative factors. Because the qualitative factors, if you look at the industry business cycle, the regulatory impact, and the government policies, from my perspective, in my personal opinion, is slightly adverse based on the information which is available to us now. So then those qualitative factors will have to be adversely rated, because all this time banks took a position up until 2021. There is no significant impact from the qualitative factors. But starting from 2021, we saw banks started rating it adversely. When it comes to 2022, compared to 2021, there will be a significant adverse further in terms of the qualitative factors. In terms of the quantitative factors, few things that we need to keep in mind is when it comes to 2022, the regulator, which is Central Bank of Sri Lanka, has given indication for capital adequacy purposes for running the stress testing framework, worst case weightage should be 80% bare minimum. So when it comes to the economic factor adjustment as well, we need to keep in mind, obviously, credit risk from a capital perspective or financial perspective, both talks about the same risk appetite or the risk category. So therefore, if the regulator requires you to stress 80% on the worst case, it's important for determination of ECL purposes. Also, financial institutions start building up a worst case scenario of 80% for 2022. So when you say the worst case scenario of 80% for 2022, meaning you will not have a best case scenario weightage, because looks like this year and next year our best case chances are very remote, but it doesn't mean that we're going to build up a completely a negative economic factor adjustment. We can factor in the growth trajectory, but that growth trajectory will be based on the events that will unfold, specifically how best we proceed with the IMF negotiation process, with the debt restructuring. If all moves on positively, we can factor in economic recovery, which will happen after a reasonable period of time. But one thing that we need to keep in mind when we build those economic forecasts, economic recovery will not happen immediately overnight. So even if we take fiscal policies in place, correct our policy decisions, align our strategies in 2022, in order to yield results of such policies, it will need a reasonable period of time. So when you look at the reasonable period of time, the growth is likely to reach us after or beyond 3 years, in the best case. So the beyond 3 years growth curve can be factored in, but it still means that in 2022, 2023, there will be economic adversity, there will be economic uncertainty. So those factors will have to be looked into, and you need to use best available information as of the reporting date. When you prepared your financials by 31st of March as of Q1, there were certain information available to you in public domain. But when we prepare our financials 30th of June for Q2, there will be additional information which is available. Likewise, on a consistent basis, as we move along the timeline, we need to keep on gathering these information, which helps us to tweak our estimates and assumptions that we put in when it especially comes to the economic factor forecast. So in terms of exchange rates, if you look at the current predictions and apply the depreciation rates on a straight line basis in different scenarios, your exchange rates are likely to exceed 600 in towards the latter part of this year or after about a couple of years. So which means you need to have capping of exchange rate as of now in a certain context, because it's highly impracticable for us to believe that at a stretch, it will go into a 600 level towards the end of this year or beginning of the next year. It was anticipated by various economists by towards the end of this year, there is a higher chance of reaching it to 500. But let's see, as of the prevalent information, we can use a particular assumption to cap the exchange rate after a particular point in time. Then, like I mentioned earlier, the qualitative scores will have to be assigned specifically on the fiscal policy side, the government stability, and industry business cycle. We will have to start scoring the situation adversely, so that qualitative factors also effectively contribute to the determination of the economic factor adjustment. Interest rates as well, we need to start considering the maximum interest rate movements for a period. It's unlikely in the long run, in the next 5 years, your interest rates would prevail at 24, 25%. There is a chance interest rates will start settling down in about 6 months period of time. Towards latter part of 20s, 70s or 80s, 17 or 18% is the best case forecast by most of the economists, that in the next 2 to 3 years, surely it will be not at 23, 24%, but it will not come back to about single digit interest rates, but surely it'll settle in between 15 to 20% in the long run, at least in the next 2 to 3 years. So those type of information will have to be factored in when you're building the macroeconomic forecast, specifically when you're calculating the economic factor adjustment. So these are some of the illustrations in terms of the GDP, inflation, interest rate, unemployment and exchange rate. You can see these are just illustrative numbers. In these, we have assumed the economy could be stagnant for about 3 years, or in the worst case, economy could deteriorate for about another 2 to 3 years, but thereafter, economic recovery could take place. But like I mentioned earlier, the basis of assumption is if we start taking the corrective action today, it will need minimum of 2 to 3 years for the economy to start picking up. And if some of these corrective actions are delayed in terms of a policy standpoint, in terms of negotiations with funding agencies, etc., the recovery curve will be prolonged. As a result, your recovery will be further delayed. So these are some of the illustrative numbers forecast that you will have to consider for determination of expected credit losses. And when it comes to impairment of financial investments, I will be moving on without taking up any questions because we have a separate Q&A lined up. The next area on impairment relating to financial investments, one thing that we need to keep in mind is specifically the country's downgrade, which took place over a period of time. As you can see, each time the reserves kept plummeting down, the rating was also downgraded, and currently we are classified into a restricted default category. So financial institutions who have heavily invested in ISBs, SLDBs, runs a risk of a significant credit deterioration, specifically relating to ISBs as well as SLDBs. So minimum provision by Q1, banks were, with the discussions that took place with the Institute of Chartered Accountants of Sri Lanka, banks were required to book in a minimum provision of 12% for Q1, specifically for ISBs. But now, since Sri Lanka have been classified as restrictive default category, as well, we are heading towards uncertain periods of time. Banks are required to, with the discussions, the regulator as well as the Institute of Chartered Accountants Sri Lanka, banks were advised to increase the provision of international sovereign bonds up to about 20%. So 20% is generally the presumption of two functions. One is currently we are in a restrictive default, which is equivalent to a probability of default 100% and a loss given default of 20%. So that's the basis at which 20% is determined. So banks bare minimum by about the third or the fourth quarter of this financial year will require to be bring in the provision of ISBs up to about 20% in order to be adequately provided for. Sri Lanka development bonds similarly will have the same issue, but in terms of the Sri Lanka development bonds, central bank is taking a different format where central bank allows the Sri Lanka development bonds to be settled in equivalent rupees or allows the rollover for the investors at a slightly higher interest rate. So if you're getting paid in terms of rupees, of course, the credit risk function will get resolved because you will get equivalent amount of rupees, and therefore instrument get wound up, as a result of which you are not required to make any further provisions. However, it'll expose the financial institutions to an open position because fundamentally these dollar deposits, dollar instruments were predominantly made from the foreign currency fundings that were made by the financial institution. So if any financial institution is opting to move on to a rupee equivalent settlement on the SLDBs, we need to be mindful that it will leave an open position in terms of their foreign currency business transactions. If the Sri Lanka development bonds are being rolled over, the ones which are at least falling due, if the rollover takes place at a high interest rate, which is to compensate for the increase in credit risk, the banks can keep the SLDB instruments under stage 1 because to consider that as a new investment and the pricing to compensate adequately for the risks that are being onboarded. But if the rollover happens at the same price, then there is significant risks where the banks will have to take without getting compensated for the risk being onboarded. At that point, the instrument will have to be pushed for lifetime expected credit loss recognition. So those are the requirements from the international sovereign bonds as well as SLDB accounting standpoint. And these are snapshots of exposures to some of those SLDBs, ISBs from the banking sector of Sri Lanka, which is publicly available information for you to refer. Right. So the next other challenge that most of the financial institutions had to go through was the business model management, because with the increase in fiscal rates, where your interest rates increased by 700 basis points at the beginning of April, another 700 basis points towards the latter part and early parts of May, led to a significant rise in interest rates in the financial markets. Also, at the same time, when the interest rates increased significantly, the instruments that were held under the fair value model, specifically the treasury bills and bonds that were kept at fair value through P&L and fair value through OCI, started realizing significant fair value losses due to the market interest rates are exponentially increasing, because the existing instruments are paying a rate of about 7 to 9%, whereas the new instruments are paying at around 21 to 24%. So obviously the fair value of the existing bond portfolio will drop significantly, which again started hurting the financial institutions. So then the question that most of the financial institutions had was, were running large fair value through P&L and fair value through OCI portfolios, whether they can do a business model change. So we thought it's right time for you to update. What does the standard expect by a business model change? Where does it constitute a business model change and where it is not? Standard is very clear to say a change in your intention relating to a financial asset, temporary disappearance in the market, or you're transferring assets from one department to another is not a business model change. So basically, a business model change is where you're taking a strategic directional change of the institution. So for example, let's say you decide you will cancel off your growth in the refinancing loan book, or you will immediately cancel off the growth rates in your retail loan book. So that's a strategic course of action for the financial institution. So those type of key decisions which impacts your strategic plan, which changes the way in which that you operate, will result in a business model change. So a mere short-term intention change, a mere change in your financial market behavior patterns, a loss of active market, a transfer of financial assets between one entity to another is not recognized as a business model change. So if you're required to do a business model change, you're required to prove the existing economic outlook has forced the financial institutions to relook at its business, the way in which it operates. The bank is no longer going to focus on the retail loan book. You're going to have a natural death on the retail loan book over the next few years. Strategically, only going to focus on the corporate loan book is one example of such business model change that is permitted under the accounting standard. The reason why most of the banks were interested to look at this business model change as of early 2022, with the steep increases in the interest rate, the fair value losses that were starting to absorb, and also at the same time, there was significant loss of demand in the credit market, where the appetite for lending was significantly lower due to significant increases of risk as well as economic factors in the country. So the banks were relooking at their strategies. Those who wanted to grow aggressively in credit is now taking a different perspective. They don't no longer want to aggressively grow the loan book, but be mindful because the external environment is quite volatile. So this led to a surplus of investments kept in fair value through P&L or fair value through OCI. Mostly it's fair value through OCI, which is no longer held for achieving a particular business model, which forces the financial institutions to rethink their strategy, whether they want to push those from fair value through OCI category to amortized cost category, where it will help you to manage your fair value losses. So then finally moving on to the impact on the stress testing, I think, which is an important aspect from a capital determination standpoint, as well as expected credit loss determination standpoint, which we saw most of the financial institutions do have a very fairly simple stress testing framework. Most of the stress tests are performed based on the significant judgment of the financial institution, where you apply a stress of 10%, 15%, 20%, 30%, likewise. And on a random basis, you try and put stress to see whether there is a breach in terms of your capital from capital adequacy standpoint. There are better ways of doing it. So some of the better ways is to look at multiple data points and fit the data into a model to define which drives your credit risk in the organization. For most of the financial institutions, it's the NPL ratio which drives the credit risk, because when the NPL ratio increases, it directly reflects the portfolio quality, as well as when the NPL ratio decreases, it reflects the improvement in the portfolio quality. So therefore, the NPL ratio was the dependent factor which drives the portfolio quality, where the dependent factor is dependent on multiple macro variables. Your NPLs are driven based on different types of macro variables. So what you do generally is you put a data lake with all of those macroeconomic variables, what you see on the slide, and then you fit a model to identify which variable contributes best to forecast your non-performing ratio. So what you're seeing is some of the random tests that have been performed on test data sets, where NPLs were generally in Sri Lankan context were forecasted based on unemployment rates, GDP growth rates, debt to income ratio, and the overall banking sector NPA with a lag of 2. So these were some of the variables that helped to forecast the NPLs in the local context, specifically using a regression type of model. And those output of the regression model, the coefficients and those weightages will be fitted in when you forecast your NPLs. So what you see is such forecasts that have been taken place. You can see the forecast of the NPL have been done under 3 scenarios: the low stress scenario, the medium stress scenario, and the high stress scenario. So the output of which, in the low stress scenario, we have taken the 85th percentile of the data points, medium stress scenario 90th percentile, and high stress scenario 95 percentile. So different NPA percentages were reached as of Q2 of 2022. This is for the Q2, 7.36%, and the medium stress scenario is 7.57%. High stress scenario is 8.26%. So what it tries to tell you is, in a range of outcomes that can take place, your NPLs could be either shift from 7% up to a maximum of 8.26%. So you stress at these different levels to understand whether under each of these levels bank is resilient enough to absorb the stresses that are coming from the credit risk. The biggest advantage when you move into a more scientific stress testing framework is the judgment. You try to limit the judgment whereby applying a stress of additional 20% on the NPL to see, or 25% or 30%, without relying on that. You work backwards. You first forecast your NPL under different scenarios, and then you work out your capital, which will tell you whether the bank has adequate tier 1 capital to meet the requirements under managing credit risk. So those are some of the important factors. And also, most importantly, this is something the regulator also looks for, specifically in terms of stress testing, the crisis factor adjustment. Because like I mentioned earlier, your historical data set that is used to build these models, even if you collate your last 10 years of your macroeconomic variables, the last 10 years data movement does not reflect the current economic outlook. So therefore, what it requires to look at is, specifically from a modeling standpoint, you require to capture the effect of the crisis, which is not reflective of your historical data set. So we generally bring in a separate factor adjustment to benchmark the movement of the crisis using some of the common quantitative economic variables. So GDP growth rate, inflation, interest rate, exchange rate. So we historically, using the volatility function, understand how much of a deviation of each of these variables has taken place due to the crisis, and then you map it to adjustment factor using a scoring method, and you arrive at a crisis factor adjustment, which is important because of the fact that your historical data set will not reflect the existing crisis adequately. So if you look at the crisis factor worked out for 2022 Q1 purposes, that's for the capital adequacy of the financial services purposes, it stressed the capital further by 170%. So in other words, if you had a particular level of NPLs of, let's say, 8%, and once you apply the crisis factor, it'll be increased by 170%. So that's 1.7 times. So approximately, it'll increase up to about 13-14% of NPL ratio in order to assess your capital adequacy in the worst case. So therefore, it's important to keep in mind the bottom line is, whenever you build your stress testing frameworks around your expected credit losses, around your capital adequacy computations, it's required you to look at a more scientific way of calculating as opposed to driving purely on significant judgments, specifically during these difficult times, and also bring in additional overlays, bring in additional adjustments, especially your historical data set may not be reflective of your existing context and the current condition. So with that, I think I'll close my session of the discussion. I will leave the forum for any questions during the Q&A session. Dinesh, over to you to take over the Q&A session. Thank you very much.
Thank you, Ajit, for that comprehensive presentation, which summed up the key impacts of the changes in the macro variables on financial institutions and some of the accounting aspects under SLFRS 9. So without further ado, I would like to invite the panelists for the discussion. So I would like to invite Ms. Rachini Rajapaksa, past President, CFA Society Sri Lanka and Independent Director of Nations Trust Bank, Mr. Dilshan Veerasekara, incoming Chairman, Colombo Stock Exchange and Director, CEO of First Capital Treasuries, and our presenter, Rajit. First of all, if I may start with you, Dilshan, a lot depends on the economic variables, particularly economic growth, interest rate, inflation, and exchange rates. We have seen some easing of interest rates in the recent few days. From your perspective, how do you see these variables moving in the near term? Because we saw like some of the projections where the exchange rate was projected to go up to till about 600 rupees. So from your perspective, what do you feel is a reasonable level for these variables in the near term?
Thank you, Dinesh, and thank you to the CFA Society for having me on as a panelist. Well, it's a tough question that you're asking for, and I think answers which all of market participants are trying to figure out. So on interest rates and exchange, before I come to that, let's take a look at inflation, because I think inflation drives the interest rates as well as inflation to some exchange rate to some extent. So if you look at inflation, we've already seen it touch 40% on the NCPI. I think CCPI will follow very soon, and is projected to remain elevated in the near term. Now, a result for these benchmarks to hit such high levels have been obviously the change in prices that we witnessed. Part of it is attributable to the exchange rate depreciation. We've seen from 200 it move up to 360 fairly rapidly in the month of March, but thereafter there has been some stability with central bank giving some sort of a guidance rate. However, liquidity remains pretty thin. So that's been one impact. We've also seen, I think, disruptions on the supply side. And import controls that the economy was forced to adopt as a result of COVID-19 also impact price escalations. So it's touched 40. And I think if you looked at even Rajit's presentation, he had forecasted, if I recall right, for us to end at maybe around 30%. My own personal view is it will be slightly lower. Towards the end of the year, that inflation will dip towards maybe between 20 to 25% on a point-to-point basis, but the annual average will still remain high. And I think thereafter, towards 2023 and 24, that inflation will actually ease from the current levels. So there is probably a slight variation to Rajit's presentation. I think he had projected 35% for next year. I actually think it will be slightly lower. A lot lies on external factors, commodity prices, and so on and so forth, which we can't forecast, and probably will depend on certain external developments that may happen. However, I think it's reasonable to expect that things will start getting a little bit better into the new year in 2023. Also, one thing to note of is that the central bank and the new governor, when he came in, I think have done what was required to be done, probably even though it was a bit late in the day, by depreciating the currency and hiking interest rates. Now, the premise to hike interest rates is that that will curtail demand. But I think the point to note here, Dinesh, is that it's really not demand that has driven inflation up. It is supply side disruptions, import restrictions, and global price increases on commodities that have. So I think taking interest rates up even further is not going to be very much helpful to address inflation. And I don't think you can. So taking rates up from current benchmark 14.5% on the reverse repo, we have T-bill rates between 20 and 22%, and maybe the longer term bonds between 21.5%. I don't think taking that up further and driving that through rate hikes will address inflation in the first place, and will actually be detrimental to the country and the economy, because don't forget, the largest cost for this government in terms of the budget deficit and their expenses, it's your debt servicing cost. So really you shoot yourself in the foot. I think if you really increase interest rates very much more, and I don't think that's going to really curtail demand, because today demand is driven by a shortfall in supply. And it's not really more money chasing after the goods that is creating this escalation. So that's my view. On interest rates, you're right. We've seen interest rates decline from the highs. So in normal markets, you find when you sort of let it go, it'll always overshoot. And when central bank gave the 700 basis points hike, the market priced in further hikes. But I think the market has now sort of realized that that may have been a bit unreasonable. And we've seen interest rates trace back from the highs of 25%, which bills and bonds all touched on primary issuances, have traced back to a ballpark, we'll call it 21% that it trades now. So it's come off about 3 or 4% from the high. I don't expect it to come down much further right now. And I think because of the volatile environment we face, the government financing that is required for the balance part of the year. And if you look at the numbers, I think we have something like close to 1.4 trillion more of additional financing, apart from maturities, that we will have to raise for the remaining of the year. So in this context, for rates to be brought down further could be very, very hard to do. So my take is we'll probably have to deal with elevated interest rates at the current levels for the remainder of the year. And maybe towards the end of the year, based on positive developments with the IMF, we currently know the project team is in Sri Lanka. We are hoping after a 10-day visit that there will be some announcement on, at least on a staff level agreement. However, the facility will be approved maybe 3-4 months after, and the real financing may only be forthcoming towards the end of the year. So I think elevated interest rates at current levels is what we expect for the remainder of the year. Towards the end of the year, there is a chance based on all these developments that interest rates may start coming off slightly. You will possibly see that where the curve inverts. So watch out for that. Watch out for to see how the curve inverts. The last time we've seen such levels of interest rates have been in 2008 and 9. And if you go back, you would have seen rates did touch 22-23%, but soon after, early into 2009, the long end of the curve inverted down to around 17 and 18%. I expect the same to probably happen towards the latter part of this year as well. In terms of the exchange rate, it's really a demand and supply factor. I think if you take the real effective exchange rate or the nominal effective exchange rate and look at it, my opinion is the currency has depreciated too much. However, due to a lack of having liquidity, lack of having dollars, no one can really do much. So there are people willing to pay any rate to maybe, import goods or pay for certain commitments that are falling due, and that has driven up the rate. So again, on the exchange rate, I don't expect a further significant devaluation of the rupee, depreciation of the rupee, and I expect it to hold to the current levels of about 360, 370 in the near term. Based on positive developments of IMF, I'm actually bullish on the currency. To me, I think ideally the currency should be trading around 300 to 320 rupees. I know a lot of people laugh at me when I tell this, but fundamentally, I think that's where the value of the rupee lies. However, whether it will actually appreciate and come to that will be dependent upon flows. With the IMF and maybe certain positive developments that can transpire, we may hope that some inflows will realize that will result in stabilization of the exchange, because it's going to be very, very hard for all Sri Lankans if the currency depreciates any further. So I would actually put my money again on the currency being relatively stable and possibly appreciating towards the end of the year, as opposed to a further devaluation. I hope I answered your question, Dinesh.
Thanks, Dilshan. So Rachini, if we turn to you, we heard from Rachit in the presentation that the recent changes are likely to have a negative impact on the capital adequacy levels of the banks. As a director of a bank, how do you see it from the bank's perspective, and what measures have banks implemented to mitigate the impact to the extent possible?
Thank you, Dinesh, and thank you to the CFA and ENY. I think Rajit did a wonderful presentation. And so let me start off by just giving the brief explanation about capital adequacy. Capital adequacy is actually the Tier 1 ratio, Tier 1 capital divided by the risk-weighted assets, or Tier 1 and 2 capital both divided by the risk-weighted assets. So if the risk-weighted assets of the bank goes up, then the capital adequacy will come down. Or at the same time, if the numerator, that is the Tier 1 and Tier 2 also comes down, the capital adequacy ratio will come down. Right now, the Tier 1 is the capital plus retained earnings, and Tier 2 is inclusive of subordinated debt. So there are impacts on both the numerator and the denominator. On the numerator front, the good side is, since the interest rates have gone up, the banks will have higher earnings, and of course that can lead to higher profitability, but subject to, like Rajit said, there is impairment that can happen on loans and advances. There is impairment that can take place on ISBs and SLDPs. So those will negatively impact the profitability of the bank, especially this year. So there is what has been built up to now. Then there will be the profits that will be added this year, minus these impairments that will take place. And also on top of that, there is also super gains tax that has been imposed in onto the banks and the most institutions that has higher profitability. So therefore, there is an impact on retained earnings, which means again, there's an impact on your capital adequacy because the numerator is going to get impacted. Then lastly, of course, then I think Rajit also touched on the mark-to-market losses of your trading portfolios. So that also will impact negatively. But of course, that depends on the duration of the portfolio. I believe most banks have short duration portfolios, and within about 1 year, most of these losses, the mark-to-market losses will hit the P&L. But of course, if you hold those assets to maturity, then you will see the mark-to-market losses getting reversed, and those provisions hitting back to the P&L and the retained earnings, and you can increase your capital adequacy that way. On the denominator side, of course, the risk-weighted assets, if there's a deterioration of the risk-weighted assets, if there's an increase in your risk-weighted assets, your capital adequacy will come down. Now, with the depreciation of the rupee, when you convert your foreign currency assets into rupees, your LKR risk-weighted assets on your foreign currency goes up. And with that, your denominator goes up, and that will also have an adverse impact on your capital adequacy. So when you consider all these factors at the moment, there is stress on the capital adequacy ratios of the banks. But at the same time, there can be mitigating measures, as you said, that can be taken over a period of time. Maybe like Dilshan said, over the next 2-3 years, if the interest rates stabilize, the exchange rates stabilize, and if you hold your financial assets to maturity, some of these can be recouped. Then, of course, the expected credit losses will be provided on a very highly stressed scenario, like Rajit said. But at the same time, if you manage your credit losses and beat the expected loss level, your actual loss level is going to be lower than your expected loss levels, you can recoup some of those impairments back into the P&L and have a positive impact on your capital adequacy. Then also on the SLDBs, like Rajit said, the central bank has allowed to take on rupee payments on maturity or on interest rate repayments. Of course, if that is done, now when you invested on the SLDB, the exchange rate was at some point, now it has more or less doubled. So you can get a repayment of in rupee terms a higher value, and also now reinvest at a higher rate and earn a higher income on your SLDBs. So therefore, there's the negative factor is that you lose your dollars, like Rajit said, but of course, on the positive side, you can have a positive impact on your capital adequacy with the acceptance of your SLDBs in rupee terms. Then, of course, you can manage your risk-weighted assets. That's on the denominator side. You can manage your risk-weighted assets to be give you a better capital adequacy ratio, so that your mix of risk-weighted assets can help you. Then, of course, you will also have to have austerity measures to manage your costs, definitely. Because there will be a positive impact with the high interest rates on your NIMs, but of course, you have to have austerity measures. Then the last but least, but what you can do is raise capital on equity for tier 1 and subordinated debt for tier 2. So those are the other measures that can be taken to manage the capital adequacy. I hope I have answered your question, Dinesh.
Yeah, Yes, thanks. Lakshmi, just a follow-up question. You mentioned that one of the final options available is to raise new capital by the banks. However, if you look at the perspective of the shareholders, it may not be a very attractive investment proposition at the moment, given the high risks. And maybe banks may need to look at some non-traditional methods. So what are your thoughts on this?
So Dinesh, first of all, now as I said earlier, yes, you can raise equity with the traditional methods or subordinate the debt based on traditional methods. But of course, now subordinated debt is going to be at a higher cost, and equity also at a higher ROE. But of course, if there is less interest, especially with this crowding out effect, or with most of the funds going into treasury bills and bonds, there might be difficulties for banks to raise equity and subordinated debt. So because of these factors, central bank also has given some relief measures. One is for the banks to use the capital conservation buffer, that is the CCB, which is 2.5% on that can be released for capital adequacy purposes. What is meant by that is, now the domestically systemic important banks have a tier 1 ratio of 10% on capital adequacy, and on total capital adequacy, the ratio is 14%. For the other smaller banks, the tier 1 ratio is 8.5%, and the total ratio is 12.5%. But of course, if you release your CCB of 2.5% on all those 4 ratios, the rates will come down, and the total ratio for domestically systemically important banks ratio will be 11.5, and for the other banks it will be 10%. So therefore, there is a leeway for the banks to also have time, buy time to, maybe if there's issue with the capital adequacy falling, you can buy time to make adjustments. At the same time, then also the central bank has allowed the banks to amortize your mark-to-market losses on your investment assets and the financial assets, that's the ISPs and the SFDBs also, over a period of 2 years, so that it wouldn't impact your capital adequacy ratio this year in 2022. But by end of 2023, the full impact will be felt, and then you will have to take the necessary measures to increase your capital adequacy ratios back to the normal levels. So that's an interim measure, but I feel on a long-term basis, the regulator also has to help the banks. Right now, the banks cannot securitize the corporate debt portfolio or the leasing portfolio, card portfolio, and the housing loan portfolio. So if the banks can securitize those portfolios, there will be a lot of funding that can be taken and to help the balance sheet. Then also in Sri Lanka, we have not seen yet where banks or financial institutions sell their portfolio of bad loans or some of their portfolios which they don't want in their books. Because when you grow, some of the portfolios will have threshold limits which are very small, and you don't want to have it in your portfolio. So you can offload those to a company who will be interested. Bank can probably sometimes offload some of those portfolios to NBFIs. So if some of those measures can be implemented in Sri Lanka, of course, we can see non-traditional methods of raising capital by banks, I suppose.
Okay. Thanks, Lakshmi. If I may turn to you, Rajit, we have seen, as you mentioned, as well as Rajini mentioned, some of the regulatory forbearance measures adopted by the central bank to smoothen the impact of the mark-to-market losses. Also considering the fact that majority of these losses will unwind within a reasonably short period of time. So my question is, how does the actions of Sri Lanka Central Bank compare with the actions taken by the regulators in the neighboring countries, mainly India, Pakistan, and Bangladesh, which is also experiencing some stress at the moment?
Yeah, Dinesh, I think to answer your question, it's quite common and obvious for the regulators in any part of the world to provide timely and reasonable support which is consistent to make the financial or to maintain the financial stability of the financial services sector. So what you see specifically in terms of some of these regulatory forbearances given in terms of allowing the fair value losses to be deferred over a period of 2 years is mainly to support them that they will not have unexpected stressors onto their capital, because this is driven predominantly on the fiscal policy decision to increase the policy rates of the country, the interest rates of the country by 700 basis points. So if you really look at if the other neighboring countries, even though they have relatively stress, but I wouldn't say they go through the same process or they go through the same magnitude of impact that currently we are going through or experienced. So therefore, time to time, if you really look at it, even time, if you go back 1.5 years or 2 years, debt relief supports through moratoriums, reasonable level of supports have been provided by regulators, not only in India, Pakistan, Bangladesh, but also in other countries such as Philippines, Malaysia, Singapore, Hong Kong, etc. So these type of actions are generally anticipated from the regulator, but this will not distort the financial reporting per se, because what we need to understand is the financial reporting aspect is completely different from the regulatory reporting aspect. So for financial reporting purposes, there are no reliefs provided. So whichever the fair value loss of your portfolios carried at fair value, it could be fair value through P&L or fair value through other comprehensive income, will have to be recognized into your P&L or the other comprehensive income respectively. But however, for regulatory reporting purposes, from especially a capital adequacy standpoint, when they perform their computations, the day one impact, so it's very, very, very important that we understand it's not a blanket relief provided by the regulator. It's a day one impact of the 700 increase of basis point. That amount of the fair value, you can defer it over a period of time. So therefore, it's only from a regulatory standpoint, which is common in other countries as well, whenever the countries go through difficult periods of time.
Okay, thanks, Rajit. One tool that banks can use to manage capital is securitization, which was also touched by Rajini. Unfortunately, the current legal framework in Sri Lanka does not support true sale type securitization. Do you think having the enabling legal framework for securitization would help the banking sector in the long term to better manage their risks and capital?
I think, Dinesh, of course, yes, the word securitization, I would say, even though we use that there is securitization in our local market, for me, technically, it cannot be defined as securitization, where we are just looking at collateralized lending. Because if you really look at the real form of securitization, like you said, surely will enable the financial institutions to remove certain parts of their portfolio from their books and giving access to immediate liquidity and capital at the same time. But in Sri Lanka, if you look at the securitization, it's more or less cash flow back lending. So for example, if say you have a leasing portfolio, when you get into a securitization, what happens is you keep the cash flows of the leasing portfolio as a collateral, and you give a loan back to the finance company or the bank. So the if you look at the on balance sheet, the leasing portfolio that you have pegged will remain an asset of that particular company. But in the real life of structuring a securitization deal is where you form a special purpose vehicle, and you sell your leasing, part of the leasing, or whichever the portfolio, how it could be housing or personal or retail, and you value that special purpose vehicle and issue an instrument on that special purpose vehicle for potential investors. So if you really look at it from the bank or the finance company's perspective, it will allow you headroom because you're scrapping a part of your portfolio, which will allow you to regain immediate liquidity into your system, also improve some parts of your risk-weighted assets. So if obviously it will give you some amount of headroom in terms of your capital management as well as liquidity management, which can use for portfolio expansion. But in Sri Lanka, unfortunately, we don't do that structuring for various reasons. Like you said, the legal environment and certain parties view it as capital implications as well, because the capital structure of the country is not very favorable to run a pure securitization deal. So therefore, we are using the term securitization and continuing with asset-backed lending, collateralized lending, which is conventional type of lending. But surely, like you said, if we bring back that legal framework, structure those type of transactions, it'll allow the companies to get rid of certain parts of the portfolio and create headroom for their capital as well as liquidity. Dinesh, I think you're on mute.
Hi, am I audible now? Sorry. Yeah,
Yes.
if I may turn to Dilshan now. In Rajit's presentation, we saw the significant exposure of the banking sector to ISBs and SLDBs. Based on the recent rating downgrade, the markets expect some haircuts to come to at least on the ISB portfolio. One of the areas you operate is in the primary dealer industry. And based on the market sentiments, what sort of haircut expectations are there in the minds of the investors in these type of instruments? Because as we know, it's trading, if you look at the market price, it is about 50-60% discount to face value. So considering that, what are the expectations of the bondholders?
Sure. So I think what's interesting to note is the distinction between foreign debt and domestic debt that central bank themselves have made. And the SLDBs have been classified, Dinesh, under the domestic debt component.
Yeah.
So it's not part of the foreign debt, whereas ISBs form part of our international debt. Now, we've gone on record to say that what's on the table for a potential debt restructure negotiation is only the foreign component. And we've had our governor formally sort of make that comment. We've also had the advisory panel saying, look, domestic debt is off the table. And that assurance has sort of been verbally given. And I think at various forums, they've sort of said this. Now, given that context, if you purely go by what has been said, I think you're saying, look, domestic debt is not going to get restructured. So therefore, even your SLDBs that have been classified under that will not require haircuts. However, we don't know what will happen to the foreign component and what percentage of haircut would be applied on the foreign component. We also know, if you look at Sri Lanka's debt dynamics, we have essentially 60% of our debt in domestic form and only 40% in the foreign currency form. So you would argue for debt to be sustainable, how can you exclude that 60% and make debt sustainable for the 40%? So therein lies, I think, the concern that market participants have had, even though assurances and statements have been given, whether that will be acceptable by the country's creditors, especially the foreign creditors, who will look and say, look, why should I take a haircut because I hold only 40% when you have domestic debt, which is probably a bigger cause of concern that is making your debt unsustainable and not taken a haircut. So it'll be interesting to see how these negotiations, firstly on the debt restructuring side and our creditors go, and also what the IMF would require us to do and maybe ask of us to do. The one thing we know so far is we know that we suspended interest payments and suspended servicing of foreign currency debt in early May, and officially went into default. However, on the Sri Lanka development bonds, what we've seen is the government saying, look, we can either roll over a maturing SLDB, where you roll over at the prevailing rate of interest that you subscribed for. So that option is given to the investor. Second option is that if you want your money back, we'll pay the equivalent in rupees. And we've seen a lot of investors, because these are predominantly domestic investors, SLDBs are held by Sri Lankans who may have foreign currency, but banks and Sri Lankans. And some of them have very well taken the view that, look, I want my money back, and therefore I will take the rupee equivalent, and it's been converted at the central bank rate, which I think is, again, fairly priced. So in that context, I think any commercial bank who so far have asked for repayment in rupees would have got that for their SLDBs, but not so obviously for the ISPs, where the payments are suspended and would depend on the outcome of these debt restructuring and other discussions with creditors that we will go into in the coming weeks and months. Like I said before, you asked for a number. It's very difficult to put a number there. And even in terms of debt restructure, there are a lot of ways that it can be done. Haircuts are one way. You could also restructure future cash flows so that you may not take an immediate impact on a potential repayment or a maturity, but you may actually have deferment of that over a period of time at a lower interest rate. So you're forced to roll over, not at the elevated interest rates of 20 plus today, but maybe at a lower rate of, I don't know, I'm just picking a number for the sake of it, 10 or 12%. And you defer that impact in terms of, so there are various ways the restructure can go. I think the challenge would be both from the central bank perspective and the people involved in these discussions is how to convince foreign creditors that restructuring is the best way, and that would make it the best possibility for them to really receive some part of their investment back. As you said, markets have already priced in 30-40% potential haircut by looking at the current prices that these bonds are trading at. So one would even argue, look, these guys have already taken that impact, because you would have had to market your investments. Most of these ISBs are held by, we know, American and European based funds that have already taken that impact based on market prices. So the pain, I think, is going to be less. There is expectation that you're not going to get your 100% back anyway. But it's left to be seen. So I think the trick here and the challenge for the team is going to be to convince that, whatever the haircut that you're required to take ultimately has to make the debt servicing sustainable going forward. And I think that will be quite challenging to do with leaving the domestic debt component untouched. However, because of the impact that may have to the entire financial system, and that comes about because we spoke of only the ISPs and SLDBs, but there is a statutory requirement for banks for liquid assets, and most banks hold up to about 20% of their assets in local rupee government securities. If you take in the NBFI sector, up to about 10% is held in rupee government securities. And if you take insurance companies, there's a mandatory 30% requirement. So if you go and give a blind haircut there, how will that impact all of these regulated institutions in Sri Lanka? I think really that's going to be, financial sort of chaos to the levels we've never seen before, because everyone potentially will go and say, look, I also will default. What's stopping a bank say that if government can default, why can't I default? Why don't I then as a bank ask a depositor to take a haircut on the deposit? So because of all of these sort of challenges that are there is why I think we've gone down this path to say that, look, we are able to service domestic debt. We are able to increase whatever. I think we've done some changes on, taxation, all of that, and keep it sustainable. But yes, we have an acute dollar problem. And that's why we are only looking at the dollar creditors being restructured. So I don't know how far that will be successful, but that's the path that we seem to be going. But very difficult question, Dinesh, for me to put a number. And I think, I will only go to say that possibly the foreign creditors may need deeper haircuts if you really leave the rupee component untouched, but we'll have to see how that pans out. Thank you.
Thanks, Dichan. I fully agree. It's a tough questions, and many aspects need to be balanced in arriving at that decision. So if I just could go back to Rajit, during the presentation, you highlighted the various stress tests done by the banks, and it provides a lot of insightful information both on a qualitative and a quantitative basis. At the moment, from what I understand, these stress tests are largely used for internal decision making and not widely published for the benefit of shareholders and other stakeholders. With the changing environment, will there be a requirement for this rich information to be more broadly shared in the market?
I would say, Dinesh, will be a little bit of a difficult one, because reputational risk for financial institution is one of the greatest, because see, if there is information in public domain that there is a closer proximity under different scenarios, there are A, B, C, D institutions running thin on their capital, that immediately can cause for a significant chaos in the market. So if you really look at it, this is very, very, very secure, confidential type of information kept behind the walls of the bank, and only the regulator have the privy to look at it, because of the reputational risk. You can see just like how happened in Sri Lanka, the mindset of the customers, the fuel or any other the commodity. The no sooner you see that there is a shortage, the response from the consumer or the users of the system is completely different. So to safeguard that stability, I believe this is some piece of information that needs to be confidential with the regulator and the respective institution, and it should not be in the public domain. But what is important is, which I was not really able to articulate during my session because of the limitation of time, for banks to look at different ways of simulation. See, the outcome of the simulation or the stress test, yes, it will tell you whether you're in breach of capital or not. But that's not the real value addition. The real value addition is you find that point where you're vulnerable in terms of your capital adequacy and work backwards. What is the level of NPL you will be vulnerable if you get to it? So obviously, if you can do simulations and identify if at NPL levels of 15%, the bank is vulnerable in terms of breaching the tier 1 capital, then bank can work backward their strategy. When I say the strategy, the underwriting strategy, work backwards their risk appetite statements, their risk limits, etc., so that you will not get to a position as such. And also it will give you a lot of resolution headroom if you know that you're in breach of your capital tier 1 if your NPL reaches this level, and also helps you to plan out your resolution of recovery planning. A bank can get into a breach, but it doesn't mean immediately it gets into a breach. That's the end of the story. You can get into a regulatory bailing out. You can start negotiations with your regulator. You can plan out your recovery options. You can manage your liquidity, because all of these connects to liquidity as well. No sooner your credit risk increases, your cash flows dried out, it also impacts your liquidity. So the impact of, or the importance of stress testing framework for a financial institution, as opposed to using models run through judgment, is that you get into a more scientific method of determining where your chances of going wrong are very slim. And also you have different simulations where you have worked out different scenarios so that you will not get into that point whenever the situation becomes quite difficult. So that's why the stress testing becomes very important. I think that's one of the reasons why the regulator is stressing on the fact that there needs to be a minimum of 80% of risk weightage, especially under the worst stress scenario. So those type of information will be important for the readers, because if you ask from any financial institution, do you understand the point of vulnerability in terms of getting your NPLs into 8%, 10%, 12%, 15%? What's your point of vulnerability? Sometimes bank may be finding it difficult to answer that question, but this is some piece of information the bank needs to have.
Thanks, Rajit. We are almost up on time, but I would like to post one final question to Dilshan.
Yeah, go ahead, Dinesh, I can hear you.
Yeah. Hold on. So Dilshan, from the broader capital market perspective, what innovations can we do in this challenging environment to attract new capital for particularly financial institutions, or to release capital, or to better manage risks? Because in other markets, there are certain instruments like derivatives which are not available in this market. So given what's happening and your assumption as chairman of the stock exchange, what do you see as potential innovations we could do to help financial institutions?
Sure. Yeah. So, Dinesh, I think in terms of looking at the innovations and introducing new products, all of that, prior to that, we really need to look at, why have we not been able to attract foreign capital right throughout, and why have been the FDI numbers been, pretty bleak over the last couple of years. And I think the answer to that question has been that successive governments have not had a policy consistency in the policies that we've adopted. We've gone about, changed almost everything we've done in the last 10 years. Even if you go back, you will see whether it's from taxation or certain regulations, things have changed quite a bit. And that has resulted in a loss of confidence for people to come in. Just to give you sort of, one example, you can see how tax laws change pretty frequently. We've reversed the tax decisions we brought in, I think, November 2019. So in less than 2 years, things have sort of, really turned upside down. Similarly, if you go back, there has been several inconsistencies in policy that has held back the private sector even being able to attract this foreign capital and the FDIs flow. So I think we need a period of consistent policy to remain, and I would think at least a 5 to 10 year window that there are no significant changes, even at these elevated levels of tax, whatever it is, that you have consistency. So then I think investors can make a fairly, rational decision based on the variables that they know. That's the first thing. Secondly, I think we've been if you take capital markets, we've been a dual product market. So we have equity, we have debt. We really don't have anything much more than that. And we've spoken of derivatives and various other products for the last 25 years. but we've really not successfully been able to introduce them. So I think that's second. And in that respect, I know the Colombo Stock Exchange has done a lot of work to enable such new products to come in. And I think with the legislature of the SEC Act being passed, that makes it now the groundwork has been done, the flow has been set, and I think we can now go about introducing rules and whatever other needed things to sort of bring these products. We did float a dollar board on the Colombo Stock Exchange, allowing local companies to actually list and raise capital in dollars. However, again, issues with regard to the exchange rate, the control in capital accounts, inconsistencies in converting dollars because of liquidity issues. So we know even now there are investors who came through IIA account, converted dollars, invested in capital market products, but maybe 1 year ago decided because of the outlook not being good to sell those investments and take their money out, but they are yet unable to sort of convert the rupee proceeds to dollars, and the exchange rates moved 80%. So where do you stay? So I think those are things that we are trying to work on now to ensure that when we bring these new products, also the environment that the investors will have to operate within will not be as restrictive or prohibitive as it is today. So new products is one thing. We are looking at you all spoke of securitizations. I know the legislature, again, laws don't permit true securitization, but the Colombo Stock Exchange is working on mortgage-backed securities. So we've had several rounds of discussion with even banks to look at MBSs being floated as an alternative and a workaround to the restrictions we have from a legal perspective being sorted out so that banks can operate more efficiently with regard to their capital, sell portfolios off their balance sheet, so on, and raise the liquidity and re-lend that cash there again, creating far more positive economic activity. We are also working on various derivative products to look at launching, we've launched REITs. Unfortunately, the operating environment, again, timing hasn't been great. Interest rates have moved up to 25% when rental yields are at 6%. So sort of almost killing the product because of that disparity. And we can't see that correct in the near future. Rental yields are not going to go up to match interest rates. So it's a hard environment. But I think those changes need to be done. And the Colombo Stock Exchange, I know, is going to be a catalyst to that. Hopefully getting all the capital market players on board, also institutions such as the CFA on board, to try and have these products and move forward from being a very simple dual product market to a far more extensive market that enables foreign investors to actively participate, and thereby for Sri Lanka to actually attract that capital, because that is the only way we are going to get ourselves out of the mess we find ourselves in today. And unless we can attract that foreign capital, the resources within the country, I don't think are sufficient to pull us through. So we all need to rally around, put our heads together and come up with the required solutions so that capital markets and businesses in general, the economy in general, can really attract the foreign capital that is required. So these few things are being worked on, Dinesh, and it'll be good if, all market participants, all stakeholders in that sense, rally around and try to help the country get out of what we find ourselves in today. Thank you.
Thank you, Dikshan. It's heartening to note that CSC is spearheading these initiatives. And from our side, we'll be more than happy to support these initiatives which will benefit the country. So with that, I would like to bring today's webinar to a close. And I would like to thank all our panelists for their participation today, and our co-organizer, Ernst & Young, for collaborating with us in today's webinar. I would also like to take this opportunity to thank our sponsors, our platinum sponsor, Colombo Stock Exchange, our silver sponsors, Equity Partners, CAL, First Capital, NDB Capital Holdings, Senfin, and Userbase. as well as our knowledge partner, Equity Knowledge Partners, and our media sponsors, Daily FT, and text messaging partner, TextWave. I would like to wish everyone a good evening and thank you for joining today's webinar.
Thank you. Good evening.
Thank you. Thanks, everyone.